Hey, good afternoon, everyone. I'm just going to open up the chat box and just make sure. Can everyone hear me? Okay, if you can, if you put a yes in the chat, I'd really appreciate it. Okay, great. And if there's any problem with the audio at any point, just let me know. For some reason, I've been having a little problem, not with the mic, but with this attachment to my computer. So if there's any problems, let me know. Now I have the chat open, and if you have any questions that come up throughout the presentation, just type them in, and I will go over all of the answers. I'll review all the questions at the end. So what I'm going to be reviewing today is our I call it our code breaker credit spread strategy. It's a very, very unique way to configure credit spreads. Credit spreads are a very advantageous way to trade the market. They're really important. They're an important tool to have in your tool belt if options are really what you're looking for. And they're a great way to leverage the market. Like today, in a blisteringly negative market, we wound up making money, and I'm going to show you just how we did it. Now, I'm going to start with this quick disclaimer that all signals and trading opportunities that we provide are for educational demonstration purposes only. Everyone should understand that trading involves substantial risk, and a person will lose a substantial amount of money and never risk more than you can afford to lose. Now, with that said, I just want you to know that this is a unique service and that I take every single trade that I send out to you in my real money portfolio on Thinkorswim. All the targets that I send out are the targets I set. All the stops are the stops that I set, so that when we hit a target, I know it. I know exactly how much money we made. If we hit a stop, I know it. There's no guesswork. Everything is done for you. And you're going to see that. Today on the credit spread service, I had to send out 3 emails throughout the course of the day. One in the morning, one in the mid-afternoon, and one about 3 o'clock in the afternoon, just to have our trades evolve and take maximal profit on each position. Now, this is our right line trading team. It is growing. We're bringing in a lot of young talent, and along with the old talent, and I'm really proud to be associated with everybody. And just to give you a quick background on myself, I graduated from an Ivy League university, went to the University of Pennsylvania for 8 years. I graduated with a degree in applied mathematics, and I graduated summa cum laude with honors. After graduation, I was inducted into the Phi Beta Kappa Honor Society, and it was always my goal to go into teaching. I applied to a number of universities and wound up taking a full-time position at Thomas Jefferson University. While there, I published 15 peer-reviewed articles in top-tier journals. I taught an enormous number of undergraduate and graduate students. I've always considered myself to be a scientist, a teacher, and an academician. I look at the market really from a scientific perspective, and we do everything that we do is rule-based. I've been an invited speaker in many countries internationally, and an invited speaker in many cities domestically, and just estimate that I've mentored close to 30,000 traders over the course of the last 12 years. Now, a lot of people in trading options jump from strategy to strategy instead of focusing and mastering any particular one. Now, it is my predisposition to be a naked trader. And what a naked trader means is you like to buy calls, you like to buy puts, you do not like to buy spreads. And I personally believe that spread trading is really a tremendous hindrance to your overall performance. I mean, if you believe that you're going to have a nice bull move, you buy a call. If you're going to believe you're going to have a nice bearish move, you're going to buy a put or a number of puts. I just don't think that buying spreads is advantageous, except when it comes to credit spreads. I'm going to show you exactly why. Now, as General Patton said, using steamroller strategy, that is, make up your mind on a course and direction of attack and stick to it, is really important. The way we trade credit spreads is totally formulaic. You're going to see exactly how I do it, and you're going to understand the methodology. Nothing is black box. I want you to understand exactly what I do. I'm going to show you all the closed positions, actually the last few closed positions in the portfolio, the ones that are open, and the positions we closed today. Now, the thing about credit spreads also are they are extremely friendly to small accounts. You just want to trade a couple of spreads. You can make really, really nice money risking a very tiny amount of money. Now, in some cases, that's also true of buying calls or puts. But when you trade credit spreads, it's almost always the case. And you're going to see the kind of credit spreads that I'm looking for. We call them one wide, $1 wide or $2 wide, maximum $5 wide, so that the risk that you're going to take on the spread is going to be exceedingly minimal. Now, what's really important, and the reason that I had to send out 3 alerts this afternoon, is that I meticulously manage all open trades. I mean, as the trade evolves, and today was a really furious down day, we had to meticulously manage all our open positions. We had some nice bearish positions that made money, and I took a few of those off the table. Now we're only going to trade liquid positions for the most part. And we're going to consistently use the same strategy that I'm going to show you. Actually, eventually you're going to see it, and you're going to learn it ad nauseum, because we use the same one. Now, when it comes to trading credit spreads, these are presented in many, many ways that are simply not optimal, but in a way that allows you to say, you could, if you trade a 10 delta spread, you're going to win, since the market is telling you that you only have a 1 in 10 chance of achieving that price level. You're going to win 9 out of 10 trades. The problem is on the 10th trade that you lose, you're going to wind up giving back all your profit and then some. So you really can't go by profit loss here. You really have to go by the amount of money you risk versus the amount of money you stand to gain. And if you buy a deeply out of the money credit spread, or sell a deeply out of the money credit spread, you stand to win 9 out of 10, but you're going to get crushed on the trades. I see this all the time about how, you can win 90% of your trades, but at the end of the day, you're not going to make any money. So why learn to trade credit spreads? Well, you can make money if the stock price increases, decreases, or doesn't move at all, because what you're really leveraging here is volatility. And you're going to see volatility leaks out of the trade. Obviously, price does matter, but the value of the underlying stock can move against us, and we can still profit substantially from the trade. We know exactly how much money that we can potentially lose, so we never have to worry about the trade blowing up. And as I said, the strategy is exceedingly simple. The strategy itself, as I mentioned, is a very simple formula. The key is finding the best stocks. And that's what I have to spend a lot of time doing. Is I have a scanner, and I'm going to show you how to use that. We've already had our last educational session. We went over repairing credit spreads. Every now and then a trade is going to move against us substantially, but we can still walk away from that trade with significant profit if we know how to repair a credit spread strategy. So it's important to know that stocks actually have 5 directions. Now, you can believe that a stock is simply going to move sideways in consolidation in a very narrow trading range. and a lot of stocks do. It's called a rectangular movement. It stays within that box of consolidation, and you really don't get over a period of time any price appreciation or price depreciation. And then you can believe that a stock is going to make a bullish move, but it's going to be a very, very mild one. It's going to appreciate in price, the stock will, but it's really not going to appreciate in value significantly. And then you have the big bull moves in which you anticipate a significantly strong move to the upside. You have that weak bearish anticipation, where you believe that the underlying stock is going to depreciate in value, not significantly so, but really all it has to do is go down 10 cents from where we purchased or sell the spread, and we can make 100% of our net credit. Now, if the stock is going to make a strong bullish move or a strong bearish move, we're much better off buying a call or buying a put. But in a market like this, where we're up strong one day, down strong another, and your anticipation is a mild bullish move or a mild bearish move, or simply sideways consolidation or chop, then selling credit spreads is extremely advantageous strategy to use. Now, I wrote them in actually, just sort of reinforce it. You believe the underlying stock is going to take a strong bullish move, you're going to buy a call. Strong bearish move, you're going to buy a put. But if it's going to remain in consolidation or take a weekly bearish or weekly bullish move, we're going to buy a bullish credit spread or a bearish credit spread. Formula is identical. It's really extremely easy to master. Now, we buy 50 delta spreads. So if we just were sitting in our chair and throwing darts at a target, the market is telling us that we will get 50% of our trades evolving into winners by applying additional information like technical analysis, fundamental analysis, and what's really important, implied volatility of the position. We can markedly improve our win percentage and also markedly improve the amount of money we make on the positions that we take. So what you have to ask yourself, if you want to sell a spread, it's really, I mean, the market is really an auction-based system, but it really jumps out at you when you sell spreads, or when I mean, you're not going to sell obviously anything naked, so you really have to sell a credit spread. Unless you own the underlying stock, you're not going to sell a call. If you do, it's going to be a covered call. This is not about selling options on stocks that we own. So you have to ask yourself a question. Do you want to be up at the podium holding an item and auctioning it off, or do you want to be sitting in the audience and bidding on the item and paying a fee? That's really the key thing that you have to ask yourself. And the answer is really simple. Now, you want to be a buyer when the cost is low and the option spread or the option itself is really cheap. But you want to be the seller or the auctioneer when the value of the option is exceedingly high. And what normally pumps up the value of an option is implied volatility. So we're going to sell it to some other guy who's going to pay us a nice amount of money for the privilege of us selling it to him. He's going to hope it's going to move against us, obviously, but we have a tremendous degree of certainty it's going to move in our direction, and we're going to get to keep the amount of money that we were awarded for selling the position. So we want to be at the podium and selling when the value of the option spread is exceedingly expensive. Let somebody else have it, and we'll take the profit or the net credit on the spread. So just to reinforce, the cost is low when implied volatility is low, and the cost is usually extremely high when implied volatility is high. So we not only have, we really have two burdens on us. We have to look for a stock that we believe with a high degree of certainty is going to move in the direction that we predict, and also has a significant amount of implied volatility, and we call it IV rank, or implied volatility rank. It's a metric that you can see right on your Thinkorswim platform. It is really exceedingly easy. And it's actually reflected in the net credit that you're awarded when you look and see how much you stand to gain if you do actually execute the trade. Now, what we're looking for is for volatility to inflate the price of the spread. Now, remember I told you that the underlying price of the stock can move a little bit against us. It only has to move a few cents in our direction. It can trade flat, because as the trade evolves, the volatility that was inherent at the time we took it, that arrow starts coming in, and it's eventually going to puncture it. And boom, volatility is going to leak out of the spread. Now, what we want to do is essentially buy back a worthless spread so that we can keep 100% of our credit. Now, there's a lot of reasons why we're never going to do that. And I'm going to teach you a little bit of what's called gamma whip that occurs as the trade begins to mature and we start moving into the end of the period of time that we're holding it. And I always give a great example where I was up about 98% on a spread that I traded, a deeply out of the money spread. This is many years ago, 4 to 5 years ago, on Walt Disney. Now, I could have taken that trade and closed it out with a 99% winner. And then on the Friday of options expiration, because I wanted to be lazy and just let the position expire worthless with both legs of the spread expiring with no value, I kept it. A boutique brokerage did a hit piece on Disney, took its biggest single loss in 20 years. I lost $40,000 on the position. So we're not going to let that. That's called gamma whip, and that is where the gamma of the trade, which is a second order value and very important because it looks at delta and it looks at theta. So basically, it's looking at how much extrinsic and intrinsic value there is on the trade and how much the delta is, or for every incremental change in the underlying stock, how much the value of the option is going to change. And as the trade matures, that gamma is going to really skyrocket. That's when we want to get out of the position with a lot of nice profit before we have the potential to have somebody come out or some piece of news come out and throw a really hefty winner into a loser in which we do not have time to mend. So critically important metrics on a credit spread position, obviously the direction, and when it's bullish, we're going to sell a put spread, the expiration date, the two arms of the trade, we're going to sell one put and buy one put, the premium width, the premium percentage, and the implied volatility rank. Now you're going to get all those metrics on every trade, and I'm telling you, this is going to be what I try to do is you earn as you learn. I spoon feed you the trades, all the targets, exactly what to do, which is why I had to send out so many email alerts today to give everybody the heads up as to what to anticipate and to let them know what I was going to do before I did it. So this will all come with time. You don't have to memorize anything. The key, though, is that IV rank, the premium percentage, and that premium width. And I'm going to show that to you on some of our open positions. Now, the credit spread formula is really easy. And I'm just going to bypass this slide because here is our formula. Now, we're going to buy or try to buy, actually sell a spread that is 45 days to expiration. Now, every now and then, that's simply not going to be achievable because it's really nice to sell monthly calls and not sell weeklies, because the weeklies tend to be more thinly traded. And as I mentioned earlier, we want to sell spreads that have really nice volume and nice open interest. But what we're going to do is we're going to sell the 50 delta put and buy the 25 delta put on a bullish position. We're going to sell the 50 delta call and buy the 50 delta call on a bearish position. Now, I'm not going to go into the credit spread distance right now. All I want to do is talk about this formula. Now, I'm going to skip this because what I want to do, and I'm going to skip this too, because what I want to do is I want to do this on Paint, and I'm going to drop the slides, and I'm just going to bring up Paint. This is the easiest way to explain it. You know, I have all these slides done, actually. Try to remember. Oh, I know where they are. Hang on one second. Let me. I'm gonna unshoot the screen for a second, and then I'm gonna bring it back in 1 minute. Just hang on a sec. Let me bring up a different deck. I should have put these slides in here, but it's okay. We're just gonna switch a little bit. So I really want you to understand what we're doing. I'm gonna shoot it back in a second. Okay, I'm gonna reshoot. Okay, now you should be able to see the screen again. Okay, now let's say that this is a slide. It's not Paint, but let's say this is a $1 wide spread. And let me give you an example of a $1 wide spread. It's right here. Let me go through this deck a little bit more carefully. I'm sorry. I should have moved a lot of these slides over. Now here's a $1 wide spread. Now this is a bearish position we took on CSX. It's still an open position. It is doing exceedingly well. I mean, today CSX got crushed. Now we want the stock to close under 31. Now you can see that the 50 delta we sold was a $31 call. The 25 delta we bought was a $32 call. That gave us a $1 wide spread. Now, because implied volatility was so high, we got 40 cents per spread on every credit spread we sold. And we risk 60 cents on every spread that we sell. So let's say that you can take $500 of risk on a given trade. You know that the most you can lose on a spread is 60 bucks. So you just take 60 and put it into 500, and that's going to give you the number of spreads that you're going to trade. It is critically important that you asset allocate so that you take an equal amount of risk on every position that we take. Now that 40-cent net credit is outstanding. So it's a $1 wide spread. The potential profit is 40 cents. The potential risk is 60 cents. If you allocate $1,000 of risk per trade, you're going to trade 16 spreads. Now, the reason we're not going to take a 15 wide is, let's say you get a potential profit of 6 and have to take a potential risk of 9. You can only trade one spread, and that's less amenable to repair just in case the trade goes against us. And these credit spreads are very repairable if the trade goes against us. Now, right here is $1 wide. Let's take CSX. We sold the 32s and we bought the 31s, and we used calls to take a bearish position. This is our 40 cents, in which if the stock falls anywhere in here, we're going to make money. If it falls below that level in here, we can take no action, and we're going to wind up with some loss on the trade. Now, if it falls below our lower bracket, we're going to do some repair on the trade. I don't want to get into that in this webinar. I mean, that was what I went over in repairing these trades. But when it comes to repairing them, they are few and far between. So I'm going to go back to the original deck. I don't want to confuse you, because if you're new to this strategy, it's going to come across as being a little bit more esoteric and more difficult to manage than you think. But it really is a very, very simple. It really is a very, very simple strategy. Now, repairing it is not necessarily as simple, but we're going to do that all together. So let me go back to paint for 1 second. And now that you have that information, you're good to know that here's what we're going to look for. And I'm going to show you a trade that we took on MUX. Now, MUX is MUX, and I'm not going to type it out, but it's McEwen Mining. Now, we sold the $7 put, and we bought the $6 put. And we were given 45 cents of net credit. So our credit was 45 cents. Whoops. Now that is an unbelievable amount of credit on a $1 wide. So the maximum we can make is 45 cents on a spread of $45. The maximum we can lose is $55. Now, if you can approach 50-50 when you sell a spread, I mean, that is an outstanding trade. Now, remember, we're trading 50 delta spreads. So we already have a 50-50 chance. We already know that MUX is in an uptrend. We believe it's going to undergo capital appreciation during the time that we hold it. All it's got to do is close at expiration 1 penny above $7, and we get to keep all $45 of every spread that we sold. So we're going to put everything in our direction on every trade. Tremendous implied volatility on this really tiny small cap stock. It was a hard stock to find, but I'll show you our scanner. Now, let me go back unfortunately, from the beginning, and I'm going to scroll to where we are now. Sorry that I've been hopping around here. But here is what I look for. I look for trades that have a rounded bottom. Some people refer to it as a frying pan bottom, but it has it scoops up a tremendous amount of trader sentiment. Now, no one's really ever looked at the predictive value of, say, of a rising triangle, falling triangle. Now, consolidation obviously has tremendous predictive value. In consolidation is a continuation pattern. A stock will move up into consolidation and then move out in the same direction and move into it. But this frying pan bottom is just a really, really advantageous formation to trade. And you can see it can extend back for months and months. Now it's going to hit a level of resistance, and when it breaks, that's where we're going to take the trade. Now, when it breaks, it's usually going to do so with a lot with a high IV rank, and it's going to give us a really, really nice winner. So Cisco had 42% appreciation in the stock. So this was obviously a full winner on our credit spread. Now here's Antero Resources, same thing, the frying pan bottom, extending back many, many months, breaking our resistance, 40% return ultimately on the stock. Our credit spread was a nice winner. Now here's Caesars Entertainment, which has really since faded into the woodwork, but this is going back. Here's that frying pan bottom, up we went. Remember, we don't need Caesars to go up, although the stock did move up 25%. All we did was needed to move up 1%. And we get 100% of the credit that we were awarded when we sold the position. So credit spread best practices. Now, if we hit 75% of our potential max gain, I'll usually close the trade. Now I'm going to show you that. Now I've taken some of the positions to 80% or more, but 75% is usually what we target. Now we're going to put a stop in that's equal to 75% of our max gain. The only way we can get burnt on the stop is if the stock gaps down overnight. And so far, it's only happened to us on one position, which is Lockheed Martin, which with repair wound up making a lot of money. And then we're going to exit 14 days prior to expiration to avoid what I told you about gamma whip. At that point, all the extrinsic value is leaked out of the position, and so is most of the implied volatility. You're going to be really in a nice position on it, and you just don't want someone to to put out a hit piece on it or some errant single piece of news that investors are going to overreact to that's going to take your position in the opposite direction. Take it off the table, put it in the bank. So we're going to look 14 days prior to expiration to close, whether we're up 25%, 30%, 40%, or even down 5%. It doesn't matter. We want to avoid some piece of news coming up that's going to take that stock and really push it in one direction, and we don't have time to do any we don't have time to band-aid the trade. We have plenty of time to band-aid Lockheed Martin to provide us with a lot of profit on the trade, but if we go out that far, we will not. Now here's your gamma. And you can see what happens as you move into expiration. It starts going like crazy. We want to avoid that. Now, here's our scanner. Now, the scanner, every 2 weeks, we're going to do an educational session. We just went over last week, got an enormous turnout. And what we talked about was how to repair credit spreads like Lockheed Martin. Lockheed Martin had news come out that their F-35s, they were only going to deliver 85 in 2023 and not 150. I didn't think it was a potentially big deal, but our investors did. The stock gapped down overnight. I didn't even have a stop in place. It wouldn't have mattered. If we would have had the stop in place, we would have gotten even more hurt. It would have been a really lousy fill on the stop. So, but what you have the opportunity to do is to buy back the bullish position and leave the bearish position in place and let the stock run to the downside. Our bearish position on Lockheed Martin wound up making 444%. In addition, I added some puts. I'm not going to go into how I knew that we were going to get a continuation to the downside here, but if we have to do repair on a trade, we will. Now, this is just the scanner, and this is going to give us the premium, the width, and this is where we start. I'm going to show you how this works in our next educational session, which is going to come up next week. And I'm going to go over all the metrics on this scanner. I'm going to show you how it's configured, and I'm going to show you how to utilize it. Everything, just like every scanner, you know, everyone tells you that, you know, their scanner's so smart, it's just going to hand you trades. Well, every scanner has to be vetted. It's got an algorithm, and that algorithm may be very, very precise and accurate, but you still need to do your own due diligence. But this is a great start. Now, this, obviously, I didn't shoot this today, but these were the trades that we would have looked at the time that I shot the slide. I'm just going to take a sip of water. Now, here are some of our closed out positions. Now, here I took a 15 wide. Now, I'm not taking any more 15 wides, but we closed it at $270 per spread, which was 80% of our $340 we were awarded at the time. Great profit on Valero. Phillips 66, I closed it at $140, which was 70% of our potential credit. We were awarded 2, but the trade was evolving. I wanted to get rid of it because we were heading towards that 14-day gamma whip position, took it out at 70%. Diamondback Energy, 67%, closed it up. Now you can see all of these are energy, and what we're always going to trade are the stocks with the strongest trend and momentum within the strongest sector. And within that sector, we're going to look in the strongest subsector. One of the trades I missed was a credit spread that I wanted to sell on the semiconductor sector. It ran away so fast that it dropped our net credit to basically, you know, almost to pennies. And I was looking for a real juicy, just a little bit of a pullback. I couldn't get it. We would have been able to execute it. We would have been off to the races. But I'm going to give you an exact limit order to enter. Simply not going to give you the 2 legs of the spread and then let you have to fumble for trying to get in. And I'm telling you, that's what 95% of these alert services do. They're going to give you both legs, and they're going to credit the trade as being executed every time at an optimal price. But I'm sitting with both legs at the limit order that I'm going to give you. Now today, I just want you to know that even though this is a credit spread service, and that's our mandate, and over 95% of our trades will be credit spreads, I think to be overly dogmatic and just lock in one type of trade configuration is a little foolhardy. So I sent everyone in the service to buy the $23 VIX calls at a limit of $1.70. Everyone got executed. We bought this yesterday, and we closed one half our positions at 50 and the other half at 91% today. Sigma Lithium, I closed 1/4 of our positions at 25%. We got some slippage, so we actually got 28%. I know that because I'm in the trade, and we're looking to sell the next half of our contracts at $3.98, which is 50%. So we're not locked into a credit spread configuration, although that will be 90 to 95% of our trades. When I see the market just crashing like this, we're going to leverage it, and there's no reason why we can't make a ton of money. We made an enormous amount of money on our VIX calls, and a nice amount of money on our Sigma Lithium puts, and what's really critical here is money in the bank. The VIX is closed, or the market could continue down, but I'm not going to leave a trade that's approaching 100% in 24 hours on the table. Because who knows, tomorrow, the way the NASDAQ is behaving, it could go up 200 or 300 points, and I'm not giving this profit back. The same thing with Sigma Lithium. It really collapsed. We're still looking for 50%. We have half of our positions open. I had half of these open. They closed us out at 91%. Now, here are some of our open positions. Now, MUX, or McEwen Mining, that's the stock. We got a 45-cent net credit on a $1 wide. That is absolutely outstanding. And that position is doing great. Our bear credit spread on CSX, we're looking to close at only 50 cents of our potential net. We may go a lot higher because CSX today really got beaten to death. So I may change that target from 20 cents down to 10 cents and look for 75 cents. Now, Marathon Oil pulled back a little bit. We've got plenty of time on the position. It's only a $1 wide spread with a nice juicy net credit sitting in the bank, and we've got plenty of time. Listen, the consumption of crude oil has not abated. OPEC is constraining production. Russia is constraining how much they're willing to let out. And we've got the current administration really putting the clamp on drilling. I mean, I follow the number of oil rigs that are out there drilling every single week, and the number that are out there drilling for oil are way down from last year. So I think we're going to hit $100 per barrel crude. Now, the only position that is potentially open for remedy is our position on Amazon. It's a 135, 140 spread. I'm not hiding anything from you. It's really taken a little bit of a beating, but remember, we have a bearish position, and that bearish position is up a ton. So we may buy back our bullish position at a loss, continue to hold the bearish position, and if I think Amazon's going to continue to the downside, we will buy some weekly puts on Amazon and really ring up the register. I want to see how Amazon trades tomorrow before I make that commitment. But I am not going to let Amazon get past us without getting out of it with some money. Every other position looks terrific. Now, again, we're going to look at the best performing sector. Right now, it's energy. It was tech, but it's been replaced. This is the most reliable. The subsector is oil, services, and drillers. I'm going to look for the best stocks in these subsectors. Now, again, this is the scanner. This is how it looks. It's colored, and the greener it is, the greater the potential premium width. Now, you see the top of the scanner is 40%, but on McEwen Mining, we got 45% of our premium width, and that is exceedingly rare. So we did better than this scanner could provide us, and we're always going to, but this is always extremely helpful. And you see, I shot this quite a few days ago, actually quite a few months ago. Now, I just wanted to show you, was one other thing here. Nope. So let me tell you what the service involves. Optimally, you're going to get 2 credit spread trades in your inbox every Sunday. Now, recently, it has simply been 1 because I don't want to extend out your capital. And this has been a very tough market. We'll go to 2 when the market starts trending a little bit better. I'm going to baby you through this whole process. You're going to get the entry price on a limit, the stop on a limit, the targets are all included. I'm in the trade with you. We manage the trade together. I get a lot of emails about positions. I'll answer everybody's emails. So we are going to be in the same canoe looking to manage these trades to ultimately provide us with profit. And if I see that we can throw a call or throw a put into the service so we can really ring the register, I did it yesterday and we banged out 91% on the VIX today. Now, your intra-week updates, I mean, if anything, they're going to burn up your email. You have to be on the lookout for them. And if you're on your phone and you get them, you're good. 3 went out today. 1 went out in the about 10 o'clock this morning. 1 went out around 1, and then 1 went out around 3. Now we're going to get bi-monthly live credit spread trading education for members only. Our last session went 2.5 hours, and it was how to repair a credit spread like Lockheed Martin that really just took a dive. But boy, did Lockheed Martin give us the ability to really rake in a lot of money by buying back the bullish position, staying with the bearish, and then adding weekly puts to it. I mean, we really, really raked it in. So I want to make you a master at trading credit spreads. You can see it's very formulaic. We're going to sell the 50 delta. We're going to buy the 25 delta. If you're going to take a bullish position, it's with puts. If you're going to take a bearish position, it's with calls. We want to get a credit that is at least 35 to 40 cents, optimally 45 cents, and then manage the trade really meticulously. Close it before we're subject to gamma whip, 14 days to trade expiration. And we look to make really, really good money. If you subscribe today, get a 70% discount. Quarterly, it's $296. Annually, it's $996. I've had quite a few people comment and actually get a lifetime subscription. So I believe that you will make that quarterly back on 1 position as long as you asset allocate across all the positions equally. And that's critically important. You don't want to take 1 spread on 1 position, 4 on another, 5 on another. You're going to decide on the amount of risk you want to take on every position, and you're going to take that amount of risk equally across every position that I recommend. There's going to be a new one coming out on Sunday, and we're going to be managing all the spreads that are there very carefully. And then next week, we're going to be having an educational session. So let me see if there are any questions. Let's just type them in. Okay. No, this will be recorded, so you can listen to it again. There will be a link that's sent out, and you will have the opportunity to come aboard. You know, I've really shown you a lot of our trades, shown you our trade methodology. Really, the key here is to find the best stocks, the ones that are most likely to go in our direction. I'm really surprised at Amazon, but we have a terrific opportunity to go into repair mode on Amazon. Like I said, buy back our bullish position, ride our bearish position to the downside. And if I think that we're really going to take a dive on Amazon, ongoing, I'm going to buy some weekly puts and really ring it up on those. Why do you have bullish and bearish positions? No, I never do that, DRK. We're only going to take a bullish position or a bearish position. If you look like I did, I think the tickers, some of them were very similar, but we're only going to take a bullish or bearish position on every ticker. The only bearish position we really have is CSX. MUX is bullish, Amazon is bullish, Marathon Oil, MRO is bullish. So the open positions in the portfolio are all bullish. You also teach cash secured puts. We're going to go over that too, Chuck, in the educational session. Yes, I think that's important, and we will do that on the educational. But just remember, very few people can deal with cash secured puts. But what we're going to talk about in the education is how to deal with assignment. Every now and then we're going to get assigned the stock. We can roll right out of it. But every now and then it's advantageous to hold a little bit of it. So there's a lot of ways that we can manage a trade that doesn't go exactly the way we want to. We're going to get 85% of our trades evolve into winners. Then the 15% that don't, there's about 10% of those can be repaired, and ultimately we can walk away with money. You just said we were going to close our bullish position and ride. That, Dirk, that may be what we do on Amazon. I mean, Amazon has really just been beaten down. The market has tremendous selling pressure. I mean, I'm not sure I see that abating. So if tomorrow Amazon was to take, say, a move up, I might look upon it. I have to see, because what I do is I look at a 2-minute chart of Amazon, and I watch it after market open, and I see how it behaves. So if it gaps up and then rolls back over to the downside, tomorrow is Wednesday, we may buy back our bullish position, stay with our bearish position, and then add some weekly puts, which are going to be exceedingly cheap. But we got to have a great short signal so we can at least guarantee a nice, even single day move down, so we can make 100+% on the puts that we buy, the weeklies. How does this compare to David Weiss's service? Well, I'll tell you, Todd, I've never gone head-to-head with David. David is absolutely outstanding. It's just a different style of trading. I mean, this is a style of trading in which we're swing trading. We're holding a position for 4 weeks or so. David Weiss's style of trading is where he's looking to hold a position maybe for an hour, maybe overnight. So, I've really never annualized the performance, and I would hate to go head-to-head with David because he's really so amazingly good. It's just a question of your time commitment. If you can sit and trade with David every day, let me tell you, he is the best of the best. If you just want to manage swing positions and win 85% or more of your trades, and the trades that we lose, we can band-aid a good percentage. This is simply a different style of trading. So I really don't want to compare it. It's a little like apples to oranges, but David Weiss's service is fabulous. We do have, what can I say, Todd? It's just really impossible. If you have the ability to sit every day, there's no reason why you can't trade both services. I mean, they're both going to bring you in different revenue streams. So it's really your call. But I'm certainly David is just really too good. Besides him being my friend, he is really just a tremendous trader. Now, we do have bullish and bearish positions, Dirk. I mean, remember I showed you today? We went and extended ourselves out, and we bought the VIX. Those are calls. That's a bearish position. The VIX is a measure of market fear, and market fear is quantitated by the number of traders buying puts. So when the market falls, the VXX skyrockets. That's why we made 91% today. bearish. Sigma Lithium. Everyone believes that even though lithium is a key component of batteries, that the world economy is going to contract and that we're going to see less cars being manufactured. Sigma Lithium has already been beaten to death. It has a lot of downside. In one day, we locked in 28%, and I believe tomorrow we'll lock in the other percentage that'll allow us to take it off the table at 50%. I want to configure the software or configure the trades so that you're going to make the optimal amount of money. And although 95% of the trades will be bullish or bearish credit spreads, every now and then we're going to throw out a call or a put. I don't want it to be dogmatic with the way we trade. It's not healthy. And what we want to do is make money. That's all that matters. But the majority, vast majority, are going to be either bullish or bearish credit spreads. Okay. So from a cash management perspective, how many trades would you need to be prepared to hold? You know what? That's a great question, Todd. And I'm going to try to keep the number of open positions around 4. Because let's say you just as a number, let's say you asset allocate $1,000 of risk per position. That's going to be $4,000 of open risk. So I don't really want to go any further than that. Maybe a 5th, but we're not going to be hanging out with very many open positions. That's why I took the VIX off the table today. I mean, Sigma Lithium is too profitable with too much downside to take off. And right now we have 4 open credit spreads, 1 bearish, 3 bullish, but 2 of the bullish position, the bearish position is collapsing. And the bullish positions are mostly in crude oil. So, and crude oil has been extremely resilient. Okay, hopefully, hold on. Hopefully you can hear me now. I hope it's back. And I'm just going to close up just by saying that, remember, I take every trade I recommend, and I'm in the trades with you at the exact price. And that's extremely rare, taking the same risk you are. So everybody have a really, really wonderful evening. Hopefully you'll come aboard and let's make money. I mean, we did today, and it's really my, I mean, I really have a vested interest in seeing that these positions evolve into winners. Everyone have a wonderful, wonderful evening. And we're going to have great educational sessions, one coming up next week. What is the window of time opportunity to put a trade after? You're going to have plenty of time, Chuck. Because remember, when I put it out there, I'm not in it yet. And I'm always going to look for a little more credit than the trade that is offered. Now, when I put out the trade on MUX, it was only being offered for 43%, 43 cents of net credit. I wanted 45, so that trade hung out for 36 hours before we got filled. So it isn't going to be like, if you're away from your computer for an hour, you're going to lose the trade. I'm always going to look for more than the midpoint of the spread. And remember, I just want to mention this, overnight and on the weekend, the midpoint of the spread is always just estimated by the market. We really don't know what the exact credit is. So I'm always going to set it at a higher number because when the market opens in the morning, it may open very advantageously and give us a fill. So if the trade comes out in the early evening, you got all night to take it and you got all morning to take it before market open. None of these are flash trades because these are not day trades, they're swing trades. So you got plenty of time to get into them. One thing I have never heard is anyone complain about trade came and by the time I saw it, it had already skipped past me. You'll have plenty of time. So everyone, again, have a really, really wonderful evening. I hope you at least learn something from this. And if you come aboard, we're going to do great educational sessions. And I take those educational sessions out as long as it takes for everyone to understand. And only those of you who belong will get those sessions on a link so you can listen to them again. Take care, everyone. And again, have a great night. Bye-bye, everyone.